Welcome to Iron Financial. We're the channel that's all about forging a stronger portfolio by putting market stories to the test. And today, we're putting Best Buy directly under the microscope. They just dropped their Q4 earnings, and frankly, the market is sending out some seriously mixed signals. On one hand, you've got these headlines screaming about a big earnings beat, but on the other, the stock actually took a hit. So our mission today is simple. We're going to cut through all that noise, we're going to analyze the structural integrity of this company, and figure out if Best Buy is a solid beam to add to your portfolio, or if it's just a value trap waiting to crumble. Let's get to work.
All right, so before we start taking a sledgehammer to the numbers, here's our plan of attack for today's investigation. We're putting this company through 5, you could say, distinct stress tests. First up, we're going to put the market's own weird reaction under the spotlight to really expose the core problem here. Then, we're diving deep into the engine room, right, to dissect this whole profit versus sales puzzle. After that, we are literally putting the balance sheet on the rack to see where its breaking point is. From there, we'll take a hard look at management's own blueprint for the future. And then finally, we deliver the iron financial verdict. Let's dig in.
Okay, let's just get right into it. The whole reason we're even doing this deep dive is because of this fundamental contradiction we saw right after the earnings came out. This is where all the confusion starts, and it's our job to bring some clarity. The market's initial move was, a classic head fake, and you really need to understand why that happened. Yeah, and this right here, this is the kind of disconnect that catches so many investors off guard. You see a headline from a place like investing.com, Best Buy surges on earnings beat. And what do you think? You assume everything's great, right? The stock might have even looked strong before the market opened. But then you look at the cold, hard data, the reality of what actually happened when the trading day was done. The stock finished the day down 2.7%. So what is it? Is the company a hero or a zero? The headline's telling you one thing, but the money, the actual flow of cash in the market, is telling a completely different story. And that, right there, is the million-dollar question. It's the whole mystery we're here to solve. Was the market right to sell off? Did it sniff out some deeper structural weakness that those flashy headline numbers just completely missed? Or did the market just overreact, maybe creating a killer opportunity for those of us who can see the solid foundation hiding under all that surface noise? To get to the bottom of it, we have to tear this earnings report apart, piece by piece. So to solve this puzzle, we have to go straight to the heart of the fight. Think of it like a tug of war. On one side, you've got the bulls, and they are armed with these powerful profitability numbers that look, honestly, incredibly strong. But on the other side, you've got the bears, and they're pointing to the top-line sales figures that are showing some real signs of decay. This is the whole conflict right here, the bull case versus the bear case, all happening inside one single report. Let's look at the evidence for the bulls first. The very first pillar supporting the bull case is right here, $2.61. That's the adjusted earnings per share. Now, Wall Street, the so-called experts, they were expecting $2.47. So Best Buy didn't just squeak by, they solidly beat them. When you look at the bottom line, the number that in theory matters most to shareholders, the company delivered way more profit per share than anyone was modeling. That's a huge sign of operational strength and some serious cost discipline. And this is the engine that was driving that big EPS beat. Just look at this number, 5.2%. That is the operating margin. So for every $100 in sales, they generated $5.20 in operating profit. Now, you got to compare that to the same quarter last year, when that number was a measly 1.6%. That is a monumental improvement in efficiency. Management is squeezing so much more profit out of every single sale. This isn't just some small tweak. It's a massive expansion of their profitability. It's a clear signal that the people in charge are executing their plan. This is some serious heavy lifting, and they are showing real results. Okay, hold on. This is exactly where the bear case starts to build its own foundation. That profitability, look, it's impressive. I'll give you that. But you have to ask, where's it coming from? This shows a comparable sales decline of almost 1%. What that means is that in their existing stores, they're selling less stuff than they did a year ago. So yeah, they're squeezing more profit out of each dollar, but the number of dollars coming in the front door is actually shrinking. You can only cut costs and juice your margins for so long if your customers are just buying less. Sooner or later, you can't shrink your way to greatness. This is the first major crack we're seeing. And here's the other side of that same coin. Total revenue came in at $13.81 billion. The analysts, they were expecting $13.91 billion. It's not just a miss, it's a confirmation of that trend we just saw in comm sales. The whole business is contracting. The top line, which is the absolute lifeblood of any retailer, it's shrinking. This is a huge red flag. You can have the most efficient, buttoned-up operation in the world, but if your revenue base is eroding, the entire structure is on shaky ground. Profitability on a shrinking pie is not a long-term growth story. It's just not. And this table, well, it lays out the entire conflict in black and white. Just look at the top line. Revenue, a miss against estimates and a decline from last year. Comparable sales, negative. Those are the cracks. But then, look at the bottom half. Adjusted EPS, a solid beat. Operating margin, a huge jump from 1.6% all the way to 5.2%. That's the steel frame. So the question for any investor becomes, which of these forces is going to win out over time? Is the strength in profitability really enough to overcome this weakness in sales? To answer that, we have to go deeper than just one quarter. We need to stress test the entire foundation.
Exactly. I mean, a good quarter on the profit line is nice, but it could just be a fresh coat of paint on a crumbling wall, you know? We need to know if this company can actually withstand a real economic storm. Is the financial structure built on solid bedrock, or is it just being propped up by some short-term financial engineering that can't possibly last? It's time to bring in the heavy equipment and run some real diagnostics.
When we talk about stress testing, this is one of our absolute go-to tools here at Iron Financial. It's called the Altman Z-score. Now, this isn't a guess or a feeling. It's a hard quantitative formula. It takes a bunch of different data points from the balance sheet and the income statement, things like working capital, retained earnings, profitability, and it boils them all down into a single, powerful score. The easiest way to think of it is like a credit score, but for a company's financial health. As you can see, anything above 3 is considered the safe zone, low chance of financial problems, but anything below 1.8 is a major warning sign. And Best Buy score? It's 3.45. This is hard empirical evidence. It's well into that safe zone. This score tells us that even with all the sales pressures, the underlying financial structure of the company is incredibly solid. It has the working capital, it has the profitability to weather storms. This is not a company that's on the brink of collapse. From a solvency standpoint, the foundation is made of reinforced concrete and steel. And that's a crucial point for the bull case.
Okay, now let's talk about valuation. Because, a solid company is only a good investment if you get it at the right price. This chart shows two key metrics: price to sales and price to book. The PS ratio is just 0.31. That means you're paying just 31 cents for every dollar of Best Buy's yearly sales. And that's near its 5-year low, which suggests that from a sales perspective, the stock is historically cheap. The price to book at 4.88 tells you what you're paying for the company's net assets. Both of these together suggest you're buying into this very solid financial foundation at a real discount compared to its recent history.
But this is where I have to step in and point out some really serious fissures in that foundation. First, just look at the beta, 1.67. This means the stock is way more volatile than the broader market. It's not a sleep well at night kind of stock. When the S&P 500 goes down 1%, you can pretty much expect Best Buy to go down 1.67%. But the second point here, this is the one that really gets me. Insider selling. The data is just stark. Over the past year, the people who know the most about this company, the executives, the directors, the people with a front row seat, have sold shares 14 times. And how many buys? Just one. So my question is this: if this company is so fundamentally solid and so undervalued, why are the insiders all heading for the exits? That is a massive red flag that you just cannot ignore.
That's a fair point, a really fair point. Insider actions always speak volumes. So let's pivot and see what management is actually telling us about the future. We need to look at their official map, which is their guidance for the next fiscal year. This is management basically telling all of us, here's what we expect is going to happen. This is their ultimate blueprint.
So for the full year, they're projecting revenue somewhere between $41.2 and $42.1 billion. Adjusted EPS, they're guiding for between $6.30 and $6.60. And here's the really crucial one: comparable sales. They're guiding for a range between down 1% and up 1%. The midpoint of that is 0, flat. So after a period of decline, they are essentially telling the market they expect to stop the bleeding and stabilize the entire business this year.
And here we are again, right back at the same conflict. The bull, the optimist, looks at this and says, great, they're guiding for flat to maybe even positive comp sales. The ship is finally turning around. They see a path to growth. But the bear, the realist, looks at the midpoints of this guidance. A midpoint revenue of $41.65 billion is below Wall Street's consensus of $42.2 billion. A midpoint EPS of $6.45 is below the consensus of $6.65. So even the company's own stabilization plan is less optimistic than what the market was already hoping for. They're basically guiding down. That doesn't exactly scream confidence, does it?
But sometimes, management's actions can speak a lot louder than their forecasts. And right alongside this pretty cautious guidance, the board approved a 1% increase in the quarterly dividend, up to 96 cents per share. Now look, a dividend is a cash commitment. A company does not increase its cash payout to its shareholders unless it is confident in its ability to generate that cash year in and year out. This is a direct signal from the board that they believe in the long-term stability and cash-generating power of the business, even if the near-term growth story is a little bit muted. It's a vote of confidence, and it's paid for with real dollars.
Okay, we've laid out all the evidence, we've gone through the conflicting signals, we've dissected that whole profit versus sales puzzle, we've put the foundation to the test, and we've analyzed the company's own blueprint for what's coming next. It's time to step back, weigh every single piece of data, and deliver the final iron financial verdict on Best Buy.
Let's just quickly summarize the bull case. The foundation looks really solid. You've got a strong beat on earnings per share, and that's driven by a massive improvement in operating profitability. The Altman Z-score of 3.45 tells us the company's financially sound as a dollar. Valuation metrics like the price to sales are near 5-year lows, which suggest it might be a bargain. And of course, that dividend increase signals management's confidence. But the cracks, they're just impossible to ignore. The company missed on revenue, and it's still posting negative comparable sales. The business is shrinking. Their own guidance for the next year is cautious, and it's below what analysts were even hoping for. The stock is super volatile, and for me, the most damning piece of evidence is that heavy insider selling. The people on the inside are just not acting like this is some kind of deep value opportunity.
So here is our final verdict. Both sides have incredibly valid points because both of these realities exist at the same time. Best Buy absolutely has a strong financial foundation. The profitability improvements are real, they are impressive, and the company is not in any kind of short-term financial danger. However, it is facing severe growth headwinds. That rock-solid profitability is being achieved on top of a business that is, factually, shrinking. And that is the fundamental tension here. Management is doing a really excellent job of managing the decline, but they haven't yet proven they can actually reverse it. And this brings us to the final, crucial question that you, as the investor, have to answer for yourself. Is this a structurally sound company that's just trading at a discount? A true, deep value opportunity? Or is this a classic value trap? A company that looks cheap on paper, but is actually hiding a slow, long-term terminal decline? The answer really depends on your belief in their ability to reignite that sales growth. The foundation is there, sure, but a house can't stand forever if its footprint just keeps getting smaller and smaller. Thank you for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.